Excuse me.
Oh, good. It's okay. You can put your Starbucks up. That's okay.
So basically what happened is crude oil was $140-something a barrel. It came down to now $40 a barrel, and there's a tremendous amount of supply. And you were talking about some of the costs that get factored in
Now,
to the futures market.
let me interject there for a second. Oil was $140 a barrel.
Right.
As I'm reading an article the other day, Goldman Sachs and all the greatest analysts in oil that you can imagine were saying oil's going to 200. There's your long-term projection.
They've adjusted those projections.
Now that the projections have been that's right, they took the zero off. Now these are the guys who wear three-piece suits, have PhDs, MBAs, all said that oil is going to 200.
Mm-hmm.
Now it's at 40. That's the short-term thing that can cut your legs out.
That's right.
While we're waiting for the 200 long-term to happen.
Yeah.
Gotcha. Okay. Just so long as I understand that.
So in the meantime, we're now dealing with a situation where crude was continued to be produced at a much greater rate than clearly the demand would support. Therefore, prices came down, and you've got a situation now where you read in the paper now where it's very difficult to find a place to store crude. And so the spot price and the price for a contract out, say 12 months from now, is $17 to $20 a barrel different. Meaning you can go buy crude on the spot market like $40 a barrel versus it might be $60 a barrel for December of 09 futures contracts. Now, is that type of situation? How do you look for that in the grains market, and do you still deal with that in the grains market as it happens in the energy markets?
Yes, there is obviously a factor to people that are looking at. We have something what we call like old crop, new crop. And that is essentially just depending on when the harvest comes. Are you going to use a calendar month that is from the old crop prior to the harvest, or something in the new crop, which is right now we are in new crop spreads. So you have things like a July NOVE contract, for instance, in soybeans, which is going to be what we call an old crop, new crop spread. And you have so many things factoring into that as far as the yield on the product, the weather, the storage costs, everything like you mentioned. But there's something called carryover, which is essentially looking at like the contango and the backwardation. And
Another term. I don't want nobody's going to understand that.
Contango.
Say it in layman's terms.
Contango future prices are higher than spot backwardation.
Spot means current price.
Correct. Backwardation prices in the future are lower than current spot prices.
So like right now, crude oil is $40 a barrel in the spot market roughly. And December 09 futures contracts might be $60 a barrel, so that would be considered contango.
Correct.
Right.
Now that's almost the same concept or same idea, where in some countries where you can buy, where you have to, a used car is more expensive than a new car.
Mm-hmm.
And you say, how can that be? Why would this used car of this type be more expensive than the new car? Because you can't get the new car yet.
Correct.
The old car, all of a sudden you just can't get that shipped to the country. So the used car is more expensive than the new car. And you say, how can that happen? It's available.
Mm-hmm. They need to drive.
That's right. They need to drive.
Mm-hmm.
So it becomes more expensive than buying a brand new one.
Correct. And they have that what we call carryover. And when you factor in your financing costs for obtaining the money to buy something in the cash market, you have storage costs, and then you also look at the futures price. There is something which you can have a spread at full carry, and essentially the market is paying you to hold that commodity. So if you have millions of dollars, because you would have to have a significantly large bankroll in order to finance a trade like that, but you would literally buy it in you would buy it and you don't have to pay to hold it. And so it's essentially something that you can hold because the storage costs and your financing costs are less than the difference between the current spot contract and the price in the future.
So what you could do right now, if you had a big empty warehouse, you could buy a whole bunch of crude oil, let's say, on the spot market and just sell the futures contracts.
Mm-hmm.
And so then you would keep the difference, I guess.
Exactly.
There's interesting articles about people actually just going out and renting super tankers and sitting them in the Gulf of Mexico because that contango in the crude markets right now, just filling them up with crude oil, hedging them with the futures contracts, and just letting them sit in the Gulf of Mexico until delivery comes.
Because they'll pay less in storage and financing costs. So, for instance, like say use the 40 to 60 example, it might only cost them say $17 in order to complete everything, like the interest rate, renting the tanker, everything like that. And
so that's $57 it costs them.
Exactly.
Per barrel, but they've sold it for $60. They got a $3 spread there.
Exactly. And so if you can sit there and essentially have all that money locked up and pay margin calls for however long it's going to take you for that to materialize, then you've essentially got, I wouldn't say risk-free, but I mean you have, in a sense, a very calculated profit.
But you do these trades like you'll lease the tanker, fill it up, and sell the future every minute. I'm just kidding.
I was going to say, no, we don't do that. That'd be a little much.
I'm just pulling your leg. Where your trades might only last a minute.
Yes.
One last thing here before we run too long. What did your experience as an intern at DWA, how'd that help you do what you do?
It's helped me tremendously in the fact that working this job now, I never thought that I would learn so much about myself and just about what it takes to be very successful in really anything you do, about the preparation, about remaining objective. And one thing about looking at the charts is that you have to remain objective. There is an art to chart reading, but at the same time, if the chart is going to tell you that you're going to need to do something, you have to do it. And one difficult thing is to have something tell you that you need to buy this, you buy it, and it goes against you. For whatever reason, it just didn't work. You buy it again, it goes against you again. Well, the third time it comes around, are you going to have the discipline in order to make that trade one more time? Because you know it's the right trade. And so that's what we call an outcome bias, is that you can't focus on the outcome of the trade. You have to focus more on why you made the trade. And it really helped me studying the charts, being able to read them well, and just learn about the markets and learn and be around successful people and find out what it takes to really, if you want to take it to the next level, what type of things do you need to do in order to do that.
And how long have you been away from the stable, so to speak?
It will be about a year and a half now.
About a year and a half. And,
yes.
And you listen to Nick now, it's just amazing to me. It makes me feel so great that we could be instrumental in helping you do what you do and where you are right now and where you're going to be in the future. It's unbelievable. But it's kind of like the same thing that John Schmidt, the professional pool player, was here talking to us. He said, I make a shot, and if I miss that shot, I hear people in the audience saying, "What stupid making that shot? Why did he do that? Why did he take that shot in the U.S. Open pool tournament?" And he says, "I take that shot because I know the probabilities are that that's going to be the right place. Whether I make it or don't make it, I'm going to do it every time if given the same circumstances." And it's the same thing you just said. Can the third time around that you have to step up to the plate and do the same thing again because you know it's the right trade?
Yes.
And that's hard to do. I mean, and one of the things that you can't do, and that I find my downfall in trading, is I tend to over leverage. So I'll take on a big position that doesn't allow me to stay with the plan. Because then when it starts going against you, it's like, oh my God, this tanker is running over me, and I got to get out of the way.
Yes.
You never over leverage your positions. You always make sure that you keep a low level of leverage.
And you have to. And I mean, especially with the volatility that's going on right now, I mean, there are plenty of guys that were great, but they're not around anymore. And you have to make sure that you are able to, you have to be around tomorrow. And part of that is not over leveraging. And to me, especially with being new, and people are saying this is historic. You go back and read books and they say, yeah, it was a wild day. The Dow's, was up 70 points. And I'm thinking, up 70? Are you talking about, a 1 minute bar, from the high to low? Or are you talking about all day, And so seeing that volatility, you have to stay disciplined.
Well, we were just talking, Paul said, the S&P, is it, or Dow Jones up 20%. In the last
average S&P 500 stock up 22% actually just in the last month.
And that's a bull market.
That's a bull market.
We've been in a bull market in the last month then.
Merry
because
Christmas.
That's the definition of a bull market. Merry Christmas. We'll see what happens going forward. Our producer is telling us that we're running out of time, so we're going to go ahead and stop here. We had fun today, and I'm glad to see Nick dropped in and get a chance to talk to him.
It's always a pleasure.